Two investors invested 1 lakh. Both stayed invested for the same period. One ended with 14.8 lakhs and the other with 18.95 lakhs. Same market, same time, different results. A gap of 4 lakhs. The investor who lost 4 lakhs did not take any additional risk. He just made one mistake every Indian investor makes, and probably you're also making it right now. You might think you have invested in all the best top rated mutual funds, different categories, different AMCs, but you have been actually making the same mistake in disguise. You are betting on the wrong horse. This hidden risk costs you lakhs in the long run, and you will never even notice it unless you see this data that I'm about to show you. This is scientific, data backed, no guesswork. And then I will also show you a powerful framework which is called the power of 3 that could have turned your 1 lakh into 19 lakhs. Power of 3 strategy is your core long-term portfolio. This will change how you invest forever. Now, we're going to compare it with 3 very interesting popular approaches, the same ones most investors are unknowingly using right now. Rupees 1 lakh is invested in 2009. By September 2025, one popular style grew 14.8 lakhs. Another fund with another second style grew to 18.38 lakhs. The third style, the power of 3, was close to 19 lakhs. And a fourth approach also did very well at 20.22 lakhs. Numbers don't lie. So which one is the right fund where most investors in your WhatsApp groups are actually owning? If you guessed it was power of 3, that's where the disappointment is. I'm not taking fund names yet. I'm just talking about styles. And that's the bit that everybody is missing. What is this hidden mistake? I will show it you in the next 30 seconds. So here is the trap. Fund-based diversification is not style diversification. Different funds of the same style often perform well at the same time that you're checking the performance. So you end up buying clones, the same portfolio in different wrappers. You think you are diversified, but your funds all behave very identical like twins. Look at this overlap. Huge duplication, same swings, same risk. That one hidden concentration, which is a single style, repeated, is what is creating this 4 lakh gap. In the next section, I'll break down the exact 3 styles that you need, the power of 3 portfolio, and I will show you how a simple mix could have avoided that 4 lakh shortfall while still keeping all the upside. So if you're owning multiple funds, it doesn't guarantee diversification. What really drives those ups and downs, the truth lies in what I call the rotation game, where winners keep changing every few years. Between 2007 and 25, the market leader kept shifting. To understand this, you need to first know every fund you own, whether large cap, Flexicap, Midcap or Multicap, they follow one of the 3 broad styles. Unfortunately, this doesn't show in any fact sheet. So you really do not know the fund's style that you're investing in. These 3 styles are growth, value and quality. Yes, there are more factors like momentum, alpha, but I'll keep it simple. Now see this data. 1 year growth style dominates, next year value, and sometimes quality takes the lead. No single style stays on the top for long, and this is exactly where most investors lose money. They are chasing whatever has just won, because when mutual funds that follow growth is doing very well, you'll open a website and check the top performing funds and you will invest in all of them thinking you're diversifying, but you have actually bought 3 growth funds with different names. Then when value starts doing well as a style, you will switch again, one step behind, entering at the top all the time. Here's what I call the power of 3. The investment engine, growth, value and quality. Each of them shine in different seasons of the market. Growth style, it captures the future trends, various innovations, the next decade stories, etc. Value finds opportunities when the crowd is giving up, the same comeback stories. Quality keeps you steady when everything is shaking. The reliable ones that survive the storm are quality. When you combine all the 3, your portfolio stops depending on luck or timing. You don't chase returns. Returns start chasing you. Let me show you this, how this mix actually performed, the data behind it. Remember the 4 lakh gap? Instead of betting everything on one single style, this framework splits your portfolio into 3 complementary engines: growth, value, quality, equal weighted at roughly 1/3 each. Each engine takes the lead in different market phases. Think of the economy in 3 broad stages: expansion, correction, crisis. Growth leads in the expansions, value performs best after correction, and quality takes charge when things go tough, during slowdowns, during recessions, etc. Together, they smooth out your ride. Here's how they stacked up over 16 years. Nifty growth style, let's say the growth sector index, delivered 17% CAGR, 1 lakh grew to 14.8 lakh. The quality, they delivered 20% CAGR, 1 lakh invested at the beginning of this research period grew to 20.2, and the value index delivered 19% CAGR, 1 growing to 18.4. And the most interesting part is that the balanced mix, the power of 3 portfolio, came in at 19% CAGR, delivering 18.95 lakhs with far lower volatility. That's the point. You don't have to pick the style that wins. You have to just own all the 3 styles. But most investors can't do that. Most investors load up just one style that worked in the past 1 year. And the moment it stops working, they will sell it and chase the next hot style. Think about it. Would you really hold on to a fund that is not among the top performers today? If you can't, then you are not following Power of 3 framework. For example, if you don't hold value during 2020, when it was underperforming, when it was a laggard, you then missed its outperformance in 23 and 24. You were not buying it cheap. You were buying it after it had recovered and became the top. This is how investors turn opportunity into regret. So the next time you feel like exiting a fund that is underperforming, just recall this data. Styles rotate, but discipline compounds. Result, investors stay busy, but their money does not. Imagine compounding 1 lakh into almost 19 lakhs, not by timing, but by a structure. So the question, which funds would you use to build the structure? My personal, and I should say it's a very individual choice, my view is that the core portfolio should include a large and mid-cap fund, a Flexicap fund, and a Multicap fund, each representing one of the 3 styles. For example, the large and mid-cap could be quality, Flexicap could be growth, Multicap could be value. So this is not about fund picking, it's about a framework thinking. And I should confess that even smart investors will be confused about what is action, what is inaction, and what is forbidden action. It's easy to mistake inaction for laziness or busy action for progress. That's where frameworks come in. You can choose your preferred funds, but make sure they represent different styles, not just different names. Even a monthly SIP across these 3 styles builds a balance, like a full body workout for your money. Now, if you're wondering which fund fits each style or how to rebalance it, you can build your core portfolio using funds that you're already investing in, already that exist. Pick one fund of each style. Growth funds capture the big uptrends, technology, consumption, the new age sectors. Quality funds focus on moats and earning stability. Value or contra funds, they find mispriced gems when the market actually gets emotional. The next step, rebalance once a year. Do not overthink timing. Just bring each piece back to roughly 1/3. Rebalancing is like checking your car's alignment, small tweaks that will keep the journey smooth. The next step, automate it with a SIP. You don't get fit by working out just once. You stay fit with consistency. The same thing with investing. Small, regular SIPs across all 3 styles is long-term compounding and peace of mind. The biggest reason investors fail is not volatility, it is behavior. When one fund underperforms, we lose patience and we switch. That's the 4 lakh mistake again. This framework is aimed to protect you from your own FOMO, your own fears. So don't chase the next hot sector. Build a portfolio that works across all weather. growth, value, quality, the power of three. If you like the content of this video, please hit the like button. Please share it with your friend and consider subscribing to this channel.